Have you ever noticed how two people can retire with nearly identical savings, yet one pays less in taxes, they keep more of their benefits, and they often feel more confident during the first few years of retirement? Now, the difference isn't always just how much money they have, sometimes it's actually when they actually retire. And that's what we're going to talk about in this video today. Most people spend years figuring out how much they need to retire, but very few spend time figuring out when they should retire. And that's very important because the month that you choose to retire could affect your overall income taxes, your Social Security planning, your healthcare costs, maybe the bonus that you're still going to receive, your pension benefits, your overall cash flow for the year, and how much you'll need to withdraw from your portfolio during this first year of retirement. And I've seen retirees improve their overall retirement outcome simply by adjusting their retirement date by a few months. And this could apply whether you have $500,000 saved, $1 million saved, or even several $1 million. So before you hand in your retirement notice, I want you to walk through what you should consider before locking in that ideal retirement date. I'm Chris Knight with Cornerstone Wealth Planning, and one of the biggest things we help clients navigate is how retirement decisions fit into the broader picture alongside your taxes, Social Security, your healthcare decisions, investment planning, and retirement income planning overall. So if at any point during this video you'd like help evaluating your own retirement strategy, then real simple, I've included a link in the description where you can schedule a complimentary call with our team. All right, let's begin. So number one, retirement timing can create major tax opportunities. Most people assume retirement makes taxes simpler. In reality, the year you retire can create some of the best tax planning opportunities of your entire life. Let's look at two examples of two couples. So both earn $150,000 per year and both plan to retire at age 62. One retires in March, the other waits and retires in December. They're the same age, they have similar assets, they have similar retirement goals, but very different planning opportunities now. The couple that retires in March may only earn a very fraction of their normal income for the year. That lower income year can create opportunities for things that may never exist again. These opportunities like Roth conversions, capital gain harvesting at potentially 0% tax rates, strategic IRA withdrawals, and overall tax bracket management. And at Cornerstone Wealth Planning, we often help our clients identify what we call ideal tax space. In simple terms, that's how much income can be recognized before moving into the higher tax bracket. So retiring earlier in the year may create significant more tax space for other strategies. And that could open the door to opportunities that aren't available once you have Social Security beginning, required minimum distributions starting, or to these income increases that come later in retirement. And of course, bigger isn't always better. So using too much tax space could create other problems that are outside of just the income taxes. So in other words, higher Medicare premiums could occur. Additional Social Security being subject to taxation, which affects other items, could occur. And you could lose other opportunities for planning for tax purposes across your overall plan. And that's why tax decisions should always be viewed in the context of the entire retirement strategy framework. So number two, your compensation structure matters. Now here's something that many people often overlook. How are you actually paid? Is there an annual bonus? And when does it pay? And when do you have to be working still to receive that bonus? When is the profit sharing contribution? What is the overall stock compensation in the vesting period? Do you have commission income that will come payable at a certain point? Are there pension credits that credit later? And what's your employer matching contribution overall that they do? Is it based on when you're still there, once a year at the end of the year? Is it done as a profit share after the close of the year? So all these decisions are very, very important. And I've seen people leave significant money behind simply because they retired a few weeks too early. One client planned to retire in the fall, and after reviewing their benefits package, It was discovered that the large annual bonus would be paid just a few months later, and so waiting a little bit longer would substantially improve their retirement position. So before selecting a retirement date, it's always worth asking these key questions. When are the bonuses paid? When do pension calculations occur and are adjusted? When the stock awards vest? When do the employer matches begin and end? And is there a service milestone, perhaps even approaching, that I'm not thinking about today? So these details can all have a meaningful impact and are all very important in the overall plan of when to retire. Which brings us to number 3. Be sure not to overlook your personal time off that's been accrued and other employee benefits. This sounds simple, but can matter more than people expect. Many employers either allow unused personal time off to be paid out or even to be used before retirement or in a lump sum once retirement occurs. So others have limitations or expiration rules that also are very meaningful and impactful. Now, the difference here could mean several extra weeks of compensation. And so before retiring, please review your vacation balances, your sick leave balances, your PTO payout rules, and your overall employee handbook provisions. Because retirement often involves these major financial decisions. So you don't want to ignore money that you've already earned but haven't been paid yet. So number 4, let's also think about your health care that may influence the timing much more than you may expect. So this is one of the biggest retirement timing surprises that people encounter. And someone is often very excited, obviously, to retire. The portfolio looks really good, the numbers work. Then they discover that healthcare costs are just much higher than they ever expected. And if you are retiring before age 65, you would need something such as looking at your COBRA coverage from your employer. Maybe you go out to the ACA marketplace to find coverage. Maybe you're looking at spousal coverage, or there's a chance you have other sort of private insurance options, which are pretty limited, but perhaps there's something out there for you. So the difference in cost could be substantial. And in some situations, delaying retirement by just a few months could create meaningful healthcare savings and simplicity. So in other words, if you're approaching Medicare eligibility, which is generally age 65, then retirement timing becomes even more important. The transition between your employer coverage and your Medicare coverage deserves this very careful planning because healthcare coverage isn't just a medical issue, it is very much a cash flow question and issue. This brings us to number 5. Understanding how the Social Security decisions are so often connected to the overall retirement timing. So many people think Social Security is simply a decision between claiming at the earliest age of perhaps 62 if you're retired, waiting to full retirement age of age 67, or waiting out to the furthest point you can, which is age 70. But retirement timing often influences the best strategy overall. So let's say you retire at age 62. Should you claim benefits immediately? Or does living off your portfolio assets first make the most sense? How about, does delaying benefits strengthen the survivor protection for your spouse? And is that the best overall decision? Would this withdrawal create additional tax consequences? And how do these decisions overall interact with one another in my integrated overall plan? Which is why we rarely start by asking simple questions such as when should you take Social Security? Instead, we want to think broader and bigger picture overall first by looking at your income, your taxes, your assets, your overall healthcare plan, and then we evaluate the most efficient claiming strategy for Social Security. Because Social Security works best when it's coordinated with everything else in your overall plan. All right, we made a lot of progress, but let's keep going here. Number 6, understand your first year of retirement looks different depending upon when you leave work. Here's what I mean. This is one of the most overlooked retirement planning factors. Let's imagine for a moment 2 retirees, identical portfolios, identical spending goals, one retiring in January, one retiring in October. A January retiree may need almost a full year of retirement income from their investments, while the October retiree, to get through the rest of this year, will only need a few months. And this could create way different withdrawal needs. Different tax opportunities will also come to the surface, different cash flow considerations of where this money comes from, and potentially it could also lead to different stress levels depending upon the overall mix for this person. So, at Cornerstone Wealth Planning, one of the first things that we always like to do is understand and calculate for people what we call their income gap. Now, this is the difference between your guaranteed income and your planned expenses. And now we identify the liquid assets that allow us to withdraw from to fill that income gap. And then next in the process that we want to calculate your overall withdrawal rate. Because retirement readiness isn't just determined by your account balances and what is in them alone, it's determined by whether those assets can sustainably support your retirement lifestyle. And retirement timing can influence that calculation more than people realize. So, number 7, the retirement date that is best for you is one that is focused on a coordinated strategy. So, a lot of people will often choose retirement dates based on one single factor. When's a birthday? When's a work anniversary? Let's just wait till year end. What's another milestone that we connect this to? There's nothing wrong with any of those. But retirement planning usually works best when these multiple factors are all considered together. When you're income tax planning, your healthcare planning, your Social Security claiming, your PTO, your bonus policies, how your pension benefits are credited, your cash flow decisions for this year, your withdrawal strategy, and your overall lifestyle and retirement goals are all put together. Because retirement isn't simply about just leaving work. It's about entering the next stage of your life in retirement with complete confidence. And confidence usually comes from understanding how all these moving pieces fit together. So overall, what month should you retire? Well, the answer isn't January or June or December. It's ultimately the month that creates the strongest overall outcome for your retirement situation. I've seen spring retirement dates make sense. I've seen fall retirement dates make sense. I've seen people benefit from waiting till just January the following year. I've seen others lose opportunities by waiting unnecessarily. So the key is understanding how each decision affects the others. Because taxes do affect your withdrawals will affect Social Security planning, your healthcare costs will affect your cash flow, and every piece influences the overall retirement strategy. So that's why our planning process begins with understanding all the different parts of your overall plan: your assets, your liabilities, your income, your expenses, identify your income gap, your liquid assets available, and that overall withdrawal rate. Because once those pieces become clear, retirement decisions often become much easier and you have much more confidence in them. So if you would like help determining the best retirement date for your own situation and you want to build a coordinated retirement strategy around those goals, real simple, click the link in the description where you can schedule a complimentary call with our team. We'll help you connect the dots across taxes, Social Security, healthcare, investments, and retirement income planning. Before I wrap this up, I have one final question for you. If retirement is on your horizon, what month makes the most sense for you to retire? Think about those questions before you do so. Thanks for watching, and I'll see you in the next video.